The summer is behind us, but some of the topics in financial markets are still with us, namely inflation and recession risk. This is what I want to talk about with Felix Brill, the Chief Investment Officer of VP Bank. Felix, you are expecting a recession in Europe. What does that mean for investors?
Unfortunately, that's not good news. A recession never bodes well for financial markets. Currently, we have to expect demand to weaken going forward, and as well, what we see is that production costs are still on the rise, adding margin pressure for companies. And on top of that, we see capital costs rising. So that is fundamentally not really a good mix. It's not really good for equities. And if we look also then on sentiment indicators, they don't look promising either. Against this backdrop, we remain cautious with regard to equities. In particular, we are underweight European and US stocks.
So the situation is not only down to rising energy costs?
No, not any longer. We see that inflation is running hot beyond energy prices. Take, for instance, the recent inflation reading in the US in August. We've seen there that core inflation, which excludes energy prices and some food prices, increased to 6.3%. That's quite a lot. And this means that the Fed remains under pressure. This also means, because we have this similar pattern in other countries, in regions, that other central banks remain under pressure as well. And as long as central banks are occupied with fighting inflation, they can't come to the rescue for the economy.
The Investment Committee has decided to increase the government bond position in the portfolios. When I think about recession or also some state bailouts we've seen, this is not really healthy for the financial profile of those governments.
Yes, I mean, government bonds help typically in a situation where recession is being more discussed at financial markets. But what you are raising, the question is on the solvency. And this is not so obvious actually in the short term, at least, because what we see also is that revenues are increasing due to inflation because tax income is going up. So this helps to finance some of the rescue packages and limits basically the risk that we really are going to discuss a solvency crisis, being it in Europe or in the US. And actually, if we have to discuss something like that, then we not only discuss the positioning in government bonds, but also in equities.
Real interest rates are still below zero. Wouldn't it be better to buy equities and/or commodities instead?
Yeah, unfortunately, it's not that easy. There are more factors at play. So for instance, we discussed the recession risks. That's clearly not a positive for stock markets and commodities. And this is actually might be positive for government bonds, because in the past they helped to diversify a portfolio, especially if markets discuss recession risks. And what's the difference now compared to, let's say, 6 months ago, is that the nominal yields are higher, so they are compensating more for the interest rate risks that come along with government bonds. And that was basically the reason we decided to go neutral for government bonds.
Thank you, Felix. And this concludes our View the Questions. I hope you like what you saw, and I hope to see you soon. Bye-bye.